Hey guys! Hi everyone! Today's video is going to be a bit unusual. This is a sequel, the second part to the previous video. I don't usually do this. Normally, in each video, I show you some tool you can use in your algorithmic trading, or I talk about a strategy I've seen somewhere, or I algorithmize something showing you how it's done. But this time, what happened is that in the last video, which I'll link somewhere up here, I shared a strategy from a YouTube video. So, I put together a strategy that was suggested in another YouTube video, and I posted its open source code in my Telegram channel. And one of my subscribers said that instead of the entry and exit system I came up with, I should do it a bit differently, and it would be more stable and profitable. Well, the most important thing is that it would be more stable. So I put together the strategy following his template, and here's what happened. This is the backtest of the strategy over the past year. In other words, the chart looks pretty stable, and I decided that it was worth making another video about it. I'll show the strategy exactly as my subscriber described it. And of course, I'll post the updated strategy code and the settings I'll be showing, how to set everything up, in my Telegram channel. Subscribe if you haven't already. And don't forget to like this video, hit the bell, subscribe, and I'll show you how to set up strategies in general. This particular strategy, and really any strategy, they're all set up pretty much the same way. So, shall we dive in and figure it out? In general, you can set up almost any decent strategy for any time frame. You can even come up with some settings for 3-minute intervals, if the strategy is actually designed for such time frames. Or you can use 1 hour or even 4 hours. That's actually much easier. A lot more strategies will work profitably on hourly or half-hour time frames. The lower the time frame, the harder it is to work with a strategy. I'll be showing you everything on a 15-minute time frame because I think that's a more or less optimal time frame. It's not as frequently changing as the 5-minute chart, and it's not as slow as the hourly, where you might only make 30 trades a year. At the same time, guys, it's very important to understand any strategy, absolutely any trading strategy, always needs some tweaks and adjustments. In short, it needs your attention. You can't just take some so-called holy grail that will work absolutely always and everywhere. Simply because that's just not how it works. You can't compare Bitcoin from 3 years ago, before there were ETFs, to Bitcoin now. They're basically two completely different currencies. You can't compare Solana from 2 years ago, when it almost crashed and the protocol just wasn't working, to now, when it's gaining momentum and becoming one of the most popular blockchains with huge capitalization and, accordingly, massive liquidity flowing through it. You just can't, you know? And if the market phase changes, if, say, tomorrow the markets crash and we enter a Great Depression, then you'll have to change your strategies again, taking into account that the market has become different. The market isn't static, and if you don't adapt to it, if you don't change, it'll eat you alive. Remember, trading is bad for your health and, in general, a very risky endeavor. And I never give any financial advice. You are solely responsible for your own money. And on that cheerful note, let's go. I'll show you how the new strategy my subscriber suggested actually works, and how you can set it up, where to start. This is the code you'll have for it. Maybe you'll want to set it up for a particular asset. It wouldn't hurt to understand how all of this works. Those who watched the previous video know that I suggested entering based on this divergence indicator. That is, working off the divergence and, accordingly, entering when the divergence is broken. And overall, it worked out pretty well, but it's quite difficult to work with smaller time frames. So, for example, it will work fine on the half-hour or hourly charts, maybe 15 minutes, but 5 minutes is too volatile, divergences break too often there. And my subscriber, after looking at this, said, what if we enter based on these diamonds? Meaning the diamonds, when we get a signal from another indicator, SR power, for a confirmed entry, right? So, the cross is just a signal, and the diamond is a confirmed signal, meaning the entry is confirmed. And we'll enter from here and trade roughly up to the middle line of the channel. That is, this will almost always be acceptable, especially if the buying strength is high, for example, or if the buy-sell ratio is positive or not too negative. I thought that overall, this is not a bad idea, so why not try this approach? And accordingly, I added a second signal system to the strategy. As you can see, I have system A for RSI Divergence signals, and system B is SR Diamond, and they can be turned on or off. So, in principle, you can enable both systems at once, but in this video, I'll show how to set up the second system separately. Well, actually, you can set it up either way, first, second, or both together. The main thing is that they don't interfere with each other. At the same time, besides adding this kind of indication system, I also added additional filters. So, if you remember, in my indicator, a signal appears first, then we check one or maybe even several consecutive candles to see if all the other filters match. Right now, they're all turned off. So basically, we check whether all these filters, which will be enabled at some point, match, and if they do, then we basically enter the trade. Besides the filters, I also added 2 exit systems. The first system is closing by the middle line, this middle line right here, but it works when the middle line is taken at the moment the trade is opened. And the second system simply tracks the middle line dynamically. Let me explain so it's clearer. Take a look. You'll see it on the replay. For example, here we enter a long position, and here is the middle line, This is the middle line that was there when the trade was opened. Here it is, right here, at a price of 111,429. Now we fast forward a bit for some amount of time, and our trade has already closed here, but as we keep fast forwarding, you can see the middle line shifts because the channel is growing or changing, and this middle line becomes dynamic. So basically, it always updates the middle line and waits until the line, well, if it's a short, crosses from top to bottom, and if it's a long, from bottom to top. That's how these two systems work. Actually, I've written a description of this entire strategy. You can also get it from my Telegram channel. There's just a description of what each function does, so it's clear how to set it up. Now I'll show you how it works in practice. I'll set up this 15-minute chart for you so it's usable. Because by default, of course, it will be unprofitable just like almost any other system. There are very few systems that are profitable on their own. Everything needs to be refined. And refining the system means filtering out bad trades. So, for example, by default, you might have 500 trades in a year. But after you set it up and cut out the unnecessary trades, you might end up with 100 trades a year, or maybe 200. Of course, it really depends on the specific strategy. But the point is that you should use different filters, basically tightening the screws on your system, to prevent it from entering trades where there are uncertainties. In other words, you want to look for the most reliable trades because win rate or profit factor is much more important than just having a ton of trades. It's better if it makes, just one trade a week, but that trade is much more likely to be profitable. Let me show you in practice how this works. Here's a test of the strategy with default settings. See what's enabled in the strategy. The second system entry is enabled, long short is on, and the strategy based on the dynamic moving average is enabled. You can also enable the static moving average at the same time. Whichever one gets triggered first, that's the one that will work. But it seems like the result turns out worse, so I'll probably just turn it off right away. Alright, let's start tightening the screws. So first we loosened everything up, and now we're trying to tighten some screws in the system. The first thing that seems logical to me is, since we're looking for diamonds, it makes sense to look for them from strong levels. So, for example, we have long filter by power greater than the threshold, and short filter sell power greater than the threshold. What does that mean? It means that when a diamond appears, this buy power should be greater than the value we've set as the filter, and accordingly, or sell power, depending on which direction the trade is going. If we check these boxes, and as you can see, we had 257 trades. If we enable the sell power and by power filters, the number of trades is cut in half. So, it threw out half the trades, but now the chart looks at least somewhat like a profitable trading strategy. Why did this happen? Because the higher this value is, the indicators weren't invented by fools, after all, and they put that number there for a reason. And this is a number that shows the relative strength of the market. When it's higher for long positions, it kind of makes more sense to go long, right? When it's higher for short positions, it kind of makes more sense to go short. That's why we just removed the weak levels. So if a level is, say, 50 or 40, why even enter there? Obviously, it's easier to break through than a level of 70, you know? And if we see a level of 70 and a diamond appears, that's great. That gives us a better chance, a higher probability, that the trade will work out the way we want. And accordingly, that's why the win rate goes up. Well, it doesn't look perfect, but at least it's something. That's why we keep tightening the screws. By the way, before this, I set pretty large stop losses for both short and long positions so they wouldn't get in our way, just so we wouldn't get knocked out by random stop losses. Because, on the 15-minute chart, it can drop 1% down and then shoot right back up. That happens all the time. And the next filter I suggest setting up and enabling is the channel height. So we enabled the channel height filter for both long and short. And now our equity curve looks even better, and we have a bit fewer trades. What does this mean? It means that if, for example, the channel height is less than 3%, well, right now in this channel, the height is 4%. If the price, the height of this channel, were lower, it would mean the market is flat and there's no point in entering. Now, let's try the other filters, which can help us further refine the strategy into some profitable options. The next filter is the threshold, the ratio of buy minus sell and sell minus buy. As you can see, it didn't really have any effect on us, well, because basically, what is buy minus sell? It subtracts this value from that one for long trades and vice versa, this from that for short trades, and looks at the difference. Since I tightened the screws pretty hard on this by power threshold filter, apparently there's no point in this one anymore. So if this filter matches, then everything matches here as well. So we'll just disable it, or, well, let's just leave it as is, let it be. Why do I leave filters at some extreme values, even if they don't affect the current time period? Because right now the market phase is, well, one thing, for example, the last 3 months were bullish, and now it's some kind of hard flat with a sharp shakeup. The market is just tossing around like a ragdoll. Tomorrow, there might even be a drop. That's why, wherever I can tighten the screws to the max, I always do it. It's better to loosen them later. If the strategy stops working, I'll just loosen the screws back if needed. But by default, it's better to keep everything as tight as possible. So what does our next filter do? Enable long ASR distance filter. Alright, let's turn it on. There we go. It also has quite a good positive effect on our trades. Let me explain why. Because this filter compares the entry point C with this line with the green zone, how close this point is to the green zone. So sometimes, for example, when there's a strong rebound like this, the entry point might be somewhere around here, and it seems like it's not that far from the middle already. Plus, there's the risk that it's just a whipsaw and it'll swing back the other way on us. So this is a riskier point than entering right at the start of the bounce from the zone. And so 0.75 means that the entry point into the market will be no further than 75% from the upper or lower boundary, depending on whether it's a long or a short. And of course, this has a positive effect on our strategy. There's also an additional divergence filter, but it restricts trades too much because 26 trades is just too few. What does it do? It checks whether there is a broken divergence level like this or an unbroken divergence level. This is an example of an unbroken divergence level near the zone where we enter. So, for example, 0.5% up, 0.5% down. It checks in all directions to see if there's any divergence level. If it doesn't find one, it doesn't enter the trade. On smaller time frames, this will probably work better, but on the 15-minute chart, it has a negative effect. It filters out too many trades. And even though the profit factor is astronomical, over 3, I think this isn't a very good option because the sample size of trades is too small. As a result, we ended up with a pretty decent equity curve like this. And if, for example, we try it over 365 days, it will basically be more or less the same. There will be some drawdowns. Where is that? That's from November to December, around New Year's. So overall, a subscriber actually suggested a reasonable strategy that you could probably apply to any fund asset, any market at all, futures, whatever you want, just because it works on basic principles. It's not just about some zones or support and resistance levels. This strategy works on bounces and rebounds from levels. Accordingly, we can fine-tune it so tightly that it will only react to very strong levels and very strong rebounds, which, as a rule, really do tend to work out. Surely, this strategy can be tweaked further, like adjusting take profits and stop losses, or maybe changing the length of this line a bit so it enters trades more often, or so the range itself is a bit smaller. Maybe you can speed up the RSI a little, or set it up to give more signals. But I'll leave that up to you. If you want, go ahead and experiment. See you next time. Bye, everyone.